If you want ultimate security, you're going to use Ethereum. It's been around longest. It's got the most number of nodes on the network. It's got, the highest value settled of all. If you want fast, cheap, and effective, Solana's been doing great.
Raoul Pal strongly opposes warnings about a tech or crypto bubble. He claims that we remain within normal trend lines. He claims that talk of PE ratios hides the effect of depreciation on prices. He further points out that Bitcoin also follows trend lines without reaching extreme highs. He relates all of this to global liquidity and debt cycles. According to him, current prices are not irrational, but mechanical. Paul claims that one cannot speak of bubbles in markets when technologies and cryptocurrencies remain below one standard deviation of their long-term trend. He argues that the bubble valuation narrative ignores how the weakening of fiat currencies is driving the PE ratio up faster than the PE. He claims that if the currency depreciates by 11%, while the real economy grows by 2%, PEs will double in about 8 years. He considers this denominator effect a key factor in rising prices. He also highlights Bitcoin's position relative to the trend. He claims that Bitcoin is currently within one standard deviation of its long-term channel. He predicts that historically it has typically reached 2 standard deviations, implying that there is still room for improvement. According to Raoul Pal, that's why big players are using Solana over Ethereum. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now, let's get back to Raoul Pal's view on Solana and the overall crypto market.
So the way I look at it as we're a $4 trillion asset class today. If I compare it to global equities, 200 trillion, global real estate, 300 trillion, global bonds, 250 trillion. So we're nowhere there yet. So if I just look at the trend rate of growth, I think we get to 100 trillion by about 2032. So that means we're only 4% of the way to 100 trillion. And that's still half the value of global equities. Now, what is the value of this thing if all equities, all bonds, and all real estate go on chain? I don't know. It's obviously not the value of the whole thing, but it's still going to be a large value. So all we're saying is we're 4% of the journey there, which makes it what I've said is the greatest macro trade of all time, because you've got this adoption curve of a technology. And unlike the internet, you can actually own a fraction of it via a token. It's amazing. These digital assets have been around for quite a long time now, over a decade. And most of the time it was retail participation. And even with stable coins, that was a retail thing. Tether was really, Asian retail being able to send money around the world and South America. And then it became Asian corporates were using it to get around capital controls. So like Malaysia to China, stuff like that, to get around the FX cross rates. So we saw a bit of that. And then this year, as soon as obviously MiCA regulations in Europe came, and then the US just basically opened the door to it all, we've seen an absolute explosion in the space on the institutional side. So we look at the adoption of the space overall. It's been growing. When we kind of rebase it to 5 million active wallets versus, let's say, 5 million IP addresses back in the early 90s for the internet was the fastest adoption of any technology the world has seen. Right now, crypto, since that date, has doubled the speed of the internet adoption. So it's been the fastest adoption of any technology, and it's now been superseded by AI. So what we've seen is massive adoption. We've now got 950 million active wallets. It's projected to get to about 4 billion by 2030.
According to Raoul Pal, current cryptocurrency price levels are not the result of speculative excesses. They are mechanically linked to currency depreciation and the lag of profits behind inflation. He rejects the idea that we have entered a self-reinforcing mania. Paul shifts his focus beyond the United States. He views global liquidity as the primary macroeconomic driver of markets. He places debt maturity at the center of the cycle. Debt burdens drive depreciation, which forces liquidity creation, which in turn influences asset prices. He notes that U.S. debt maturities have lengthened, so massive refinancings have not yet occurred. This delays the liquidity stress until 2025, deferring more of the shock to later periods. But he also notes that in 2017, even when U.S. liquidity was stable, China and the UK boosted global liquidity, keeping markets afloat. He argues that this remains the central channel. He argues that markets are less concerned with U.S. rates than with how global credit systems evolve together. He admits that the phrase, "this time is different," is dangerous, but he maintains that the mechanisms of the cycle are consistent: maturity, debt, liquidity, and price. He says he's always exposed to the upside, so he can take advantage when his opinion proves correct or adjust it when it proves incorrect. Paul believes XRP is gearing up for a breakthrough. He describes the cryptocurrency market as a kind of waiting room where different assets enter the growth phase at different times. Ethereum has already broken through. Solana and Sui are showing signs of wanting to follow suit, and now Paul thinks it's XRP's turn. His argument rests on two things: the rotation of capital out of Bitcoin and a wave of global liquidity that continues to boost risk-on assets like cryptocurrencies. Ethereum is already up nearly 70% since July, hitting new highs before pulling back slightly. Paul says Ethereum has clearly broken out of the waiting room, and altcoins like Solana and Sui are next in line. XRP, which is consolidating after a rally earlier this summer, appears to be forming a tight triangle pattern on the charts. According to Paul, this type of pattern has historically led to explosive breakouts, and XRP is now entering this new phase. XRP's price has fallen around 4% this month, but Paul points to long-term trends dating back to 2014 that have often resulted in significant gains. If XRP breaks out of the current triangle structure, it could enter a new growth phase. However, failure could push it back to the $1.7 to $2 range. Paul attributes much of this to Bitcoin's role in the cycle. Bitcoin tends to rally first when liquidity increases globally and then capital shifts into altcoins. With Bitcoin recently hitting new all-time highs, he sees this as the trigger for a broader altcoin season, and XRP could be the primary beneficiary. Paul predicted a sharp increase in cryptocurrency adoption in the coming years. While the pace of adoption remains remarkable, he predicts a massive boom by 2030. Cryptocurrency adoption continues at twice the pace of the internet. Comparing the number of cryptocurrency users to the internet, Paul predicts that the number of users will reach 4 billion by 2030. This figure is derived from an exponential graph that extends the curve from the 1 billion cryptocurrency users observed in 2025. Paul claims that this boom will take the cryptocurrency market capitalization from the current $4 trillion to $100 trillion by 2032-2034. He predicts that this sharp growth in the global cryptocurrency market capitalization will be driven by two secular trends: adoption and depreciation. Paul shared data comparing the cryptocurrency adoption rate to the internet user adoption rate after each innovation reached 5 million users. To do this, Paul compared the number of cryptocurrency wallets to the number of IP addresses. According to Paul, the total number of cryptocurrency users grew 137% annually for 9 years, reaching 659 million users by the end of 2024.